Hello, and welcome to the Q1 2020 update for the AJ Bell Fund range. I'm Terry McGivern, Fund Manager on the range, and it's my pleasure to talk you through the performance of the funds for the first quarter of 2020. Please note that this update will focus only on the growth funds in our range. The income funds were launched in April 2019, and as such, we will not discuss current or historic performance data until the funds have been running for a full 12-month period. This being the case, the Q2 2020 update will be the first one at which we will cover all funds within the AJ Bell range. Fund performance over the first quarter of 2020 has been challenging to say the least, with losses seen on all risk profiles as market participants reacted to the shock of the coronavirus pandemic. With falls seen on all major asset classes, including bonds, shares, and alternatives over the period, no fund in our range escaped unscathed, although naturally, those lower down the risk spectrum, such as the cautious and moderately cautious funds, fell less than those higher up, such as the adventurous and global growth funds, which are more exposed to riskier assets, such as shares. In our last update for 2019, over the full year, we noted that performance has been exceptionally strong and at the top end of our expectations. So whilst it was disappointing to see that a lot of that performance has been taken back, we do need to view this quarter's falls in the context of what was a very strong 2019. After a very strong 2019, we came into 2020 conscious that financial markets were at elevated levels, and as such, we didn't expect to repeat the same gains that we got last year. As advised on our last update in January, our eyes were on the Brexit transition, the US presidential election, and the US-China trade war as possible threats to financial market conditions. I don't think anybody foresaw that it would be a new coronavirus emerging in China in late December that would ultimately cause markets to reverse course and see large parts of the global economy begin to freeze up. As the severity of the virus became clearer and governments began to act, previously vibrant economies around the world came to a standstill. Businesses and citizens were forced into closure and lockdown to slow the virus's spread and impact. And in this unprecedented environment, with businesses unable to trade and no end date in sight, risk-averse investors sold financial assets indiscriminately, leading to some of the sharpest falls seen in financial market history. The graphic on screen shows the impact on regional stock markets when returns were translated back into sterling. And it's clear to see that some of the losses experienced were severe. Japan, traditionally seen as a safe haven market, was the best performing out of the developed markets, and yet still saw losses of 11% in Q1. UK stocks were particularly badly hit, with the FTSE 100 down almost 29% over the period, whilst the Msci Uk Index, which is the index that we use for the UK in our graphic, and is a broader index including mid and small capitalisation stocks, was down almost 24%. The reason for the FTSE 100 falling further was due not only to the coronavirus pandemic, but also the fact that OPEC, the oil production cartel, and Russia failed to agree to production cuts to maintain the price of oil, which led to the oil price falling over 60% from $60 a barrel to $22 a barrel. The heavy oil company presence on the FTSE 100 meant that this index saw a double whammy of pandemic selling and also oil losses, which compounded the falls which we've seen on the index. Bonds also had an interesting time over the quarter, as investors raced to judge the impact of the virus and sought the safety of cash and safe assets rather than holding risk assets. As a result, within bond markets, high-quality government bonds were preferred over corporate bonds. We hold shorter-dated UK government bonds where we have them in our funds, and after helping in Q4 2019, these unfortunately did mean we did not participate fully in the gains that we've seen on government bonds in this quarter, with investors preferring longer dated issues. However, we also hold weights in US government bonds, and with the US government bonds being seen as a safe haven, we did benefit from our holdings here, which were further enhanced by the US dollar, which rallied versus sterling in the quarter. Emerging market government bonds and global high yield bonds saw sharply negative quarters in local currency terms and sterling terms, as investors shunned riskier asset classes across the board. Lastly, within the funds, we have exposure to UK Reits, that is real estate investment trusts, and these saw heavy losses in the quarter as investors priced in the risk that shops and businesses would be closed and likely will struggle to pay rent on these properties. We updated investors on the asset allocation changes that we made to the funds in February 2020, and these were relatively minor. In the cautious, moderately cautious, and balanced funds, in the main, we upped the stock and cash weightings touched while reducing bonds and alternatives, which are currently invested in UK property. In the moderately adventurous, and global growth funds, the allocations remain very similar to those in 2019 due to the smaller weightings that were already held in bonds and the alternative buckets. A graphical summary of the high-level changes can be seen on the screen. We did also make some changes to the underlying holdings that we use within the funds. Emerging market shares, we switched our holding from an iShares Emerging Market ETF into the HSBC Emerging Market ETF. The newer product comes with a slightly lower cost of 0.15% compared to the iShares product, which was priced at 0.18%. In the funds where we use a secondary holding to ensure sufficient spread of assets, we have retained the iShares product and exited a Vanguard Emerging Market ETF instead. On Asian Pacific ex-Japan, we switched from the iShares Pacific ex-Japan ETF into the Vanguard Developed Asia Pacific ex-Japan ETF. The former holding was extremely concentrated within Australian shares, whereas the Vanguard product includes South Korea, which leads to a more diversified exposure. In addition, it also carries a lower charge of 0.15% versus 0.2% for the iShares ETF. On UK corporate bonds, we switched from the iShares Sterling Corporate Bond ETF into the Invesco Sterling Corporate Bond ETF. The Invesco product carries charge 50% lower than the old holding at 0.1% versus 0.2%. In addition, it's also focused on tracking a more tradable index, which is an important consideration within an asset class such as UK corporate bonds. In terms of the changes to the funds in response to the recent moves seen on markets, we did have meetings to discuss if any action was actually required, but we did feel it was incredibly difficult to make significant changes to the portfolios given the speed and severity of some of the moves both up and down, which were seen on financial markets. In this environment, the potential to take missteps is vastly heightened, and as such, we believe the wait-and-see approach was the best course of action in Q1. It's been an incredibly tough quarter for financial markets in Q1, with some of the sharpest falls seen in all recorded history on financial markets. In this environment, with the uncertainty created by the pandemic and no dates in sight for the ending of lockdowns and businesses to restart trading, it's difficult to make a call on what the next quarter and the rest of the year will look like. What seems likely at this point is most major economies will enter into recession as the impact starts to show up in the numbers and measurements for the economic data. As a result of this, governments and central banks globally have pledged unprecedented amounts of support for their economies and businesses, and this did give some boost to markets as we ended the quarter, with April thus far being a little less volatile. The hope, therefore, is that this continued support, combined with the potential to see positive news from a slowing infection rate as the measures taken to stop the virus start to take effect, the hope is that this should feed into confidence and that the world may be able to return to normal function, which will certainly help financial markets moving on into 2020. AJ Bell do not offer advice, so we would urge you to do your own research to ensure that any investment you select is appropriate for your financial circumstances and objectives, and also in line with your attitude to risk. If you're unsure about this, please contact a suitably qualified financial advisor, and thanks for watching.